Hi, everyone. Welcome to Be Different for Success. Today, we'll be talking about timeless rules for predicting if the stock market is going up or going down. Years ago, stock market expert Bob Farrell gave timeless rules that help predict if the stock market is more likely to go up or down. It can be a mistake to focus only on what the stock market has done recently. Yet, this is a trap that snares many investors. Farrell's classic and timeless advice provides wisdom all stock market investors can use to stay grounded and keep market cycles in perspective. Can you really know if the stock market will go up or down? Amidst the talk that no one knows for sure where the market is headed, the smart money is measuring probability by observing the many clues. These clues can predict whether the stock market is more likely to go up or down at any given point in time. Remember, with investing, we only have probabilities. While probability is far from certainty, wise investors consider probability by observing and using all available information. First, reliable fundamental data on PE ratios, yield curve inversion, and various economic activities are all valuable tools for predicting stock market direction. Second, technical analysis provides a slew of revealing data for forecasting whether the stock market will go up or down. In addition to fundamental and technical analysis, there's plain old common sense. This is where Bob Farrell's rules enter the picture. Bob Farrell's market rules can significantly help every investor avoid the ongoing hype and herd mentality about stock investing, and gain a much better understanding of the overall stock market and whether it will go up or down over the next few years. Below are Bob Farrell's market rules to remember. Number 1. Markets tend to return to the mean over time. Most stock investors know that there is an average amount the stock market moves up over time. This average is the reason people invest in the stock market in the first place. They plan to get a certain return based on what stocks have done in the past. Over very long time frames, this annualized stock market return is 10%. While a 10% average annual return sounds great, it's the occasional wild swings down that contribute to that average not being too great. A perfect example is the stock market crash in October 2007 through March 2009, when the S&P 500 dropped about 54%. You can easily see how different it feels to think about making 10% a year on the stock market versus seeing your stock portfolio decline by 54%. It helps to know that stock prices eventually change back towards the average. Returning to this average is called mean reversion. During the pain of bear markets, it's important to remember that stocks will eventually revert to the average by going back up over that average. Likewise, during the plentiful times, when stock market values have swung up higher than the average valuation, it's smart to remember that they'll need to swing way back down under the average to get back to the usual average. Not only can this mean reversion awareness ease the pain of net worth declines that occur during bear markets, but you can also tweak your investing decisions with this information to help build wealth by buying assets low and selling higher based on long-term trends. This is logical and may sound overly simplistic, but many investors don't do it. What keeps individual investors from factoring this reality into their stock market investing decisions? Needing to follow the herd mentality, lack of a plan, recency bias, emotional investing, and lack of knowledge about stock market cycles all contribute to losing money in stocks. Knowing that markets revert to the mean helps you know if the stock market is more likely to go up or down over the next few years. Looking to see how far the market has swung away from the mean and in which direction provides valuable and unbiased insights. Number 2. Excesses in one direction will lead to an opposite excess in the other direction. After bear markets, many investors swear that they'll never buy stocks again. Everything in the news is about the horrible losses that investors have had. People hate stocks to an excessive level, even though they can be bought very cheaply. Near the end of bull markets, however, everyone loves stocks. It feels like the great stock market performance will go on forever, even though stocks are overpriced based on history and no longer connected to company earnings. This excessive optimism is called irrational exuberance, and it drives stocks to levels that are no longer supported by the true valuations of the companies in the stock market. Below are some examples of stock market excesses that you may well remember, as I do. Real estate valuations in 2006 were clearly the result of excessive lending. Real estate and the financial firms lending money for real estate had to swing in the opposite direction to return to normal pricing following the excesses. The tech boom in 2000 was also excessive. The stock index that held the cutting-edge technology companies was the NASDAQ. It increased a whopping 85.59% in 1999. This was clearly excessive. The NASDAQ declined over 39% in 2000, then over 21% in 2001, and then over 31% in 2002. These downswings were obviously excessive. So in 2003, the NASDAQ swung back up just over 50%. We can see how logical the return to normal pricing is after these excessive periods. Excesses such as these make it clear that the stock market, as well as real estate and other asset classes, will need to go up or down to shake out the excesses. Number 3. There are no new eras. Excesses are never permanent. This investing rule is tied to the popular phrase that fuels many excessive valuations. This time is different. Heading into 2000, in the midst of the tech bubble, everyone thought that overall business fundamentals were different because we would all be using new technology that would change the world forever. As it turns out, we are, but even technology company valuations are affected by supply and demand, earnings, corporate leadership, and by the economy. There are no new eras. While the next era may be a little different, stocks return to valuations that make sense in relation to their financials and to historical norms. Number 4. Rapidly rising or falling markets usually go further than you think. The way I state this stock market rule is that trends last longer than you think. I have learned this truth time and time again during trends that are either up or down. As a bear market declines, stock analysts are interviewed in the media to explain how the market will stop dropping soon. Yet the downward trend continues longer than expected. And along the way up, the stock market is climbing a wall of worry, which is another popular saying. Subsequently, the stock market goes higher and longer than anyone thought it would. While I have found this rule to be true, more often than not, there are exceptions to this stock market rule. The first exception was the fast bear market that began in October of 1987, with the sudden one-day steep drop. That bear market ended only 3 months later. Another breaking of this rule was the bull market between 2003 and 2007. The average bull market lasts 9 years. So a bull market that lasted a little over 5 years in the mid-2000s seemed too short, following the nasty 2001 to 2003 bear. Number 5. The public buys the most at the top and the least at the bottom. It sounds so easy to buy stocks at low prices and sell them when they are overvalued. Nevertheless, research repeatedly shows that individual investors are the last to buy into the stock market before it goes down. Be knowledgeable and calm with your investing, so decisions are guided by logic instead of the emotions of fear and greed. Fear and greed are stronger than long-term resolve. Most people invest based on deep-rooted beliefs about money instead of the logic you see in Bob Farrell's stock market rules. These money beliefs are usually related to childhood or previous mistakes. Those invalid beliefs trigger emotional investing instead of logical investing. On the opposite end of the emotional spectrum, it can be hard not to get greedy when you see that everyone you know has built wealth from the latest stock bull market. FOMO, fear of missing out, leads investors to get into stock markets near the top of market cycles. The fear of missing out overcomes logical investing. These emotional saboteurs can be overcome by disempowering those limiting beliefs. Learning more about investing, if needed, can also solve this problem. Knowledge fuels more logical and better decisions. Number 6. The 3 bear market stages. Bear markets have 3 stages: sharp down, reflexive rebound, and a drawn-out fundamental downtrend. This stock investing rule will be important to remember during bear markets. Markets tend to fall hard and fast once the institutions begin selling. During this time, there are little uptrends inside the overall downward move. These little uptrends can give investors a good opportunity to sell stocks off the lows. Don't get too caught up in the small trends within the larger overall moves up or down, because these are tricky for even the most experienced investors. Instead, focus on the big picture, asking if stocks are overvalued, fairly valued, or undervalued. Data is easily accessible to provide the answer to this question. Number 7. Bull markets are more fun than bear markets. This is the attitude that prevails in the media and the general public during bull and bear markets. However, for logic-based investors who are prepared with extra cash on the sidelines, bear markets can be an opportunity to build wealth. Waiting to invest at cheaper prices by buying cheaper assets can be quite fun and lucrative. Thanks for watching this video. I hope you liked it. Please click the thumbs up and write your personal tips in the comments below. Thank you for your support, and don't forget to subscribe to the channel if you want to hear more from us. See you in the next video.